Good morning, everyone. I'm Rohan Shams, Director for Trading Marketing at Refinitiv. Welcome again for this fabulous webinar today, where we have great experts from Reuters and Refinitiv coming together and discussing the oil markets and what we've seen in the recent days. Very quickly, some basic housekeeping announcements. We would love to have this webinar as interactive as possible. You guys coming in with comments, questions, anything you guys want to ask with the fabulous panel we have with our disposal on the webinar today. So before I actually pass it on to our team, few very basic housekeeping announcements. You will hear from Richard, John, Dimitry, and Ranjith today, and I'll let Richard properly introduce everyone in a bit as well. But as I mentioned, we would love to hear from you. There is an option of Q&A. So if you will see the webinar screens, there should be a bar of different icons at the bottom of your screen. And you'll see the social media icons, some Q&A tabs, some resources that we've collated, and also the slides maximization or minimization options if you want to use them and utilize them as well. So please do feel free to drop in your questions. This is a listen-only webinar, so you won't have any phone line. You have to listen it through your PCs or machines or any desktops or laptops as you're using. And the way of interacting would be to put in lively questions in the Q&A bar. Also, very quickly, many of you might be aware of us anyway. We are Refinitiv. We are the ex-Thomson Reuters financial and risk business, and you know us as Refinitiv now, covering a wealth of obviously Reuters news items, different products, services, analytics, and all the different data sets that we offer globally. So I do appreciate that if you guys have any questions, even after the webinar, there will be a small pop-up survey. Please do drop us a note in that survey if you would like to learn more or have access to any one of our analytics or solutions as well. So with that, Richard, over to you to run through this fabulous webinar today.
Great, thanks very much, Rohan. So thanks everyone for joining. We've got with us Ranjith Raja, who works for Refinitiv and runs our oil and shipping research business. We've got John Kemp, who is the Reuters senior energy commentator, and if you see Reuters and you see icon, then you'll know John's columns really well, and you'll also know Zhdannikov, who is our EMEA energy editor and spends a lot of time at OPEC meetings and interviewing CEOs at BP, Shell, and the like. Dima was at the OPEC meeting last week. John was writing columns about it, and I was reading it. I used to work at Reuters. I'm Richard Mably. I run news performance at Refinitiv. So I get to spend a lot of time reading what these guys are writing and then telling them how brilliant they are, or otherwise, occasionally. So Dima, let's start with you. You were there last week. In the run-up to the meeting, you know, it didn't look certain, but it looked as if they were going to come up with at least some additional cuts. And instead, of course, you know, they've all been washed away completely. What happened, do you think? Why did they fall out?
Sure, thank you, Richard. And I think it's a great opportunity to tell our customers, to give a bit of color and sort of feeling of how it all developed. I mean, I've been covering OPEC for the past 7 years, and certainly was the most dramatic meeting my team and myself have witnessed. It probably comparable to the meeting in December 2014 when Naimi declared, when Saudi oil minister Ali al-Naimi declared his pump war, and the oil price crashed. But this time the price reaction was of course deeper, because back in 2014 the economy was doing kind of okay, unlike this time when everybody is absolutely paranoid what the virus will happen to demand. So reading the meeting, as you say, was quite challenging, and reading this meeting properly was challenging because it was developing along very familiar patterns, which is the Saudi have tried to manage the expectations down and sending signals that Russia might not be on board, and Russia was saying very little, and it looked like I mean, 5 or 6 previous meetings have developed exactly like this. So before the meeting, there were multiple signals that Russia may not be on board, and then last minute Russia was agreeing to cuts, and everyone was saying, okay, basically the Saudis and Russians have agreed to manage the expectations down and surprise the market on the upside when the meeting is over. This time the signals were pretty much similar, even though there was some strange developments, such as Russia saying we're on board but not on board, Putin holding a meeting with oil companies on Saturday and discussing strategy with them, and that sent a completely wrong signal. Everyone thought, okay, if Putin does bother to meet companies, that means that Russia is probably on board. So by the middle of the week, we were still in a situation when there were serious hopes that Russia would agree to either extend or maybe even deepen cut together with the Saudis. But then on Thursday, the situation changed completely. After we had this initial OPEC meeting, totally out of at which OPEC recommended to cut output by 1.5 additional million barrels per day and bring Russia on board, then a very unusual and strange development happened. There was a second unannounced informal OPEC meeting, which happened in the room of Prince Abdulaziz, the Saudi oil minister. Yeah. That is unheard of. I mean, it might have happened in the 80s, when Richard, you were covering OPEC meetings, but in current times it never happened before. A second informal unannounced OPEC meeting at which basically Saudis decided to double down. They said, no, we want the cuts to be deeper and longer.
They called Russia's bluff, or rather they tried to call Russia's bluff, and the Russians came back and said,
well, you can see it either way. Either they try to call Russia's bluff, or they send a message to Russia that they simply want the deal to fall apart. Right. That's another theory.
So they're both. This is the interesting thing. They both now seem to be claiming credit for calling off OPEC Plus.
Of course.
Who moved first? That's what I'm really interested in. Do you think the Russians sort of basically said, we're not playing ball because we've got to leave this to the market, we can't keep losing market share? Or do you think the Saudis came to the same conclusion?
Half of Russian oil is being produced by Rosneft, and its CEO Sechin, the chief executive figure Sechin, who is very close to Putin, has been banging on about it for 3 years. Yeah. I don't want any cuts. It only extends the lifeline to the U.S. oil output. Yeah. The problem is, for Putin, oil is not a 3-dimensional game. He plays chess in 4 or 5 dimensions, or at least he thinks he's so clever that he plays in 4 or 5 dimensions. And hence, for him, the partnership with Saudi is more than about oil. It's probably about Syria, Yemen, Palestine, God knows what. I mean, there are many, many subjects. And we still don't know what really triggered it.
But Sechin's view that the Russians were conceding market share without really doing much for the bottom line is probably what won the day, right?
It did win the day, but in combination with other factors.
With other factors,
something
we're not sure
prompted Putin to change his mind. Yeah. And
well, the other thing, of course, is that Moscow really doesn't want to be doing a U.S. industry favors. I mean, by helping prop up the U.S. shale industry, when your own state oil company, Rosneft, is being sanctioned, does not look good from a Russian point of view.
Totally not. But the Saudis are pretty much on the same page. They were looking they were looking increasingly worried by the fact that they're losing market share to the U.S. shale industry. So the funny outcome of this meeting is that even though there was a complete fallout between Saudi and Russia, they're doing the same job. They are at the moment putting the U.S. shale industry under extreme pressure.
Okay, so let's move to that one. If we can go to which slides would you like?
Yeah, if we could go to the 7th slide in your pack. I think this really summarizes the core dilemma for both Saudi Arabia and Russia. Both countries have consistently lost market share to the United States over most of the last decade. U.S. output has roughly doubled since 2011, while Saudi Arabia and Russia's output has basically stagnated. It's basically the same as it was back in 2011. Over that period of time, if we can go to the 8th slide in your pack, U.S. shale has emerged as the marginal supplier to the global oil market. In fact, in every year since 2012, with 3 exceptions, U.S. shale producers have captured all of the incremental global oil consumption. They captured almost all of it in 2012 and 2013. They captured all of it in 2014. They captured all of it in 2018 and 2019. All of those were years when the price of Brent oil was at or above $70 a barrel on average. The only 3 years in which US shale producers didn't capture all or almost all of the global increment in oil consumption was 2015, 2016, and 2017. And those were the years when oil prices were Brent was averaging $56 or less. So the indication from that is that in a high price world, US shale is basically squeezing everybody else's market share. And the question for Saudi Arabia and Russia really was then how to respond to that. And I've tried to sort of illustrate some of their strategic thinking if you turn to the 18th slide in your pack, the sort of key strategic choice for Saudi Arabia and Russia was essentially whether you try to cut production and protect prices or allow prices to decline and defend your market share. The Russian strategy going into the OPEC meeting seems to have been prioritizing to stop the erosion of market share, allowing oil prices to fall in response to the coronavirus, eliminating the oversupply in the market through a downward price adjustment. And the aim of that was to force an even further slowdown in US shale production and at the margin to try and incentivize a bit of faster consumption growth through a lower oil price environment. And underlying all of that is a long-term commitment to trying to grow Russian oil output. Saudi Arabia seems to have gone into the meeting with exactly the opposite strategy. Their focus was very much on stopping the erosion of prices. They want, as far as possible, to maintain their oil revenues in the short term. And in order to do that, they were prepared to cut production and accept a further, perhaps temporary loss of market share. They wanted very much to see the oversupply eliminated through an OPEC plus output adjustment, extending and deepening those production cuts. And again, the focus on that was maximizing short-term oil revenues. So the two sides have faced the same problem, which is the continued expansion of US shale production at sort of relatively high prices, but they seem to have come to completely different views in terms of what the best strategy is to deal with it.
Okay. So we are where we are. They came to the same conclusion from different directions. Let's talk now about what that means for the US shale industry. It's been growing fast. It had, I think one of your slides, John, shows that that actually, even at pre-OPEC meeting prices of whatever it was, $50 a barrel, it was beginning to slow. I was looking through this at the weekend. Eagle Ford and what's the other place? Bakken were already plateauing, and they're probably going to fall quite quickly. So the Permian was, really the only growth area. What does this mean now for the shale industry, given what we know about its indebtedness? And I don't know whether we know the answer to this, but we have a question relating to this from the audience. Thank you for this. Someone's saying that they've heard that 30% of shale oil producers have hedged 60% of their production at levels above $50 a barrel. Does that sound right? And how will this how will this affect their cash flow? So I'm no expert on this. We don't actually have anyone Reuters has very good people covering the US shale industry in Houston. What do you think, John, about the state of the industry now? We saw what happened in 2014. I mean, they battened down the hatches and they came back. They came back full force and they cost Ali Naimi his job as Saudi oil minister. Basically, is that what will happen this time?
I mean, hedging certainly provides shale producers with a degree of protection in the short term from a short-term downturn in prices. It doesn't protect them in the medium and long run. Past experience suggests that there is about a 4-month delay between a downturn in prices and a downturn in drilling activity in the United States. And in total, there's about 9 to 12 month delay between a downturn in prices and a downturn in US oil production. We were already expecting, even before the OPEC plus meeting broke up and prices plunged, based on the reduction in prices that we saw late last year and at the beginning of this year, we were already expecting US oil production to slow quite sharply. A couple of years ago, 18 months ago, US oil production was growing at a year-on-year rate of about 2 million barrels a day. By the end of last year, that had fallen to a year-on-year growth rate of about 1 million barrels a day. We were already expecting it to fall to about 400,000 barrels a day by the end of this year, and maybe 600,000 barrels a day by the end of next year. In the light of the plunge in prices that we've seen following the OPEC meeting, those forecasts have all now been revised down. The EIA published new US oil production forecasts yesterday, which show that effectively US oil production will be basically flat year on year at the end of this year, and flat year on year again.
Do you think those predictions take a bit of time to put together? The economy is looking worse day by day, and the price of oil is looking poor day by day. So there won't be there won't be the demand, and supply will obviously be badly hurt by $30 a barrel. There's a question I'm going to come to about price in a minute. But do you think those EIA presumably projections have only got one direction to go from here?
I mean, all the risk I think is currently on the downside in terms of US oil production. Already you've seen a lot of US shale producers saying that they intend to start idling rigs within the next few weeks.
So what was in 2014? The rig count went down. One of our questions is saying by 60%. Across, I think we're talking, sort of lower 48, excluding the Gulf.
So what was interesting in 2014 was that the dynamics. So prices peak in July 2014. The US rig count starts to really decline in about October 2014. US oil production actually peaks in April 2015, and it doesn't start to decline year on year until the end of 2015. So it's quite a long, slow adjustment process, which was one of the problems, one of the reasons why oil prices fell so low in 2015 and then into the beginning of 2016, was that the adjustment from the US shale sector was really, really quite slow. This time, I think there is a possibility that the adjustment could be a lot faster.
Right. Okay.
If you think back to 2014, US shale producers, there was a lot of bravado about we can survive this. We are not going to cut production. We will see off OPEC. This time, I think there's completely the opposite. A lot of shale producers came out at the weekend saying we're going to start cutting rigs. Production is going to start falling.
So there's lots of things different than previous price crashes. Demon, I was going to ask you, do you want to say something about shale? Because I wanted to ask you about what you think the Saudis are actually going to do. That's a big question. They have the biggest spare capacity. Yeah. Ranjith.
So just to touch upon the rig count that John was talking about a little while earlier, it's actually quite interesting to see how the numbers have actually worked out from the time. So if we look at, like John mentioned, at the end of 2016, the U.S. output was roughly somewhere in the range of about 8.7, 8.8 million barrels per day. And if we look at how they have capitalized in terms of the production cut agreement from OPEC for the last few years, they have increased it to almost 13 million barrels as of the first quarter of 2020. And if we essentially see, the interesting part there is also how they have been able to increase or ramp up their production output by actually a drop in the number of rigs that are operating. So in 2018, they reached an all-time high of about 888 rigs that were active, and currently that's dropped by almost 200 rigs. That's roughly about 680 currently. So they have actually managed to increase and ramp up their output in spite of having a drop, which essentially shows how resilient they have become.
It's about efficiency, and we know that's how the shale industry works. It's become more and more efficient. But it's going to be tough at $30 a barrel unless, it will force more efficiencies. And if there were a rebound,
I think they've reached a point. I think they've reached a point where they've reached their efficiency and resilience at around $45 somewhere. But at the current price point, it is going to be a pain point for them, and that is something that they will have to start looking out. And like Dimi mentioned, or John mentioned earlier, if the prices are going to sustain, then it's going to be the ones which are with the high depth and high exposure that are going to be starting to shut down their rigs very soon.
Good
well,
point.
Of course, I mean, yes, I agree. I mean, they might have reached the resilience at the level of 45, but I mean, it really differs by balance sheet by balance sheet. If you have borrowed much more and you have to pay a very heavy dividend, then you are in trouble. And we've seen almost a knee-jerk reaction, immediate, like Occidental cut dividend by 86% and capex by a third. And Chevron said they are cutting capex and looking to reduce production. And that's only just the tip of the iceberg. I'm sure we'll see more announcement. But to your question on what the Saudis is going to do, that's exactly $1 million question that everyone is asking around these days. I mean, the U.S. administration is thinking about putting together a rescue package for the U.S. shale industry, and the one question they are asking themselves is what the hell the Saudis going to do. So
let me just get to that, Dima. So on the one hand, as Donald Trump said, this is good for gasoline prices. He's heading into an election. Really cheap transport fuels are good for Americans. However, as we've seen time and time again, the price of oil is very closely correlated to the economy not doing very well, and crucially for the president, for equities, which he's staked a lot on. He's been very proud of what the Dow's done. It's gone up from 15,000 to almost 30,000, nearly doubled during his tenure, which is pretty amazing. And now he's losing a lot of that. So if he does decide that they're going to spend money on the U.S. shale industry, it won't be a huge amount, because he doesn't. I don't imagine that he really wants to see oil prices to go too high, right? Is there a balance for him between supporting the industry and letting prices?
Maybe he will just. I mean, if you read his book from 20 years ago, I mean, he's very, very eloquent about OPEC. He hated OPEC big time. So for him to act like a member of the cartel would be very strange. Very strange. Maybe he will simply let things go as they are.
Well,
and in that respect, he and his administration will be looking exactly for answers what Saudis and Russians could do.
What do you think they'll do? What will they, and this is for anyone, I really don't know the answers. What do you think the Trump administration is going to say to the Saudis right now? I mean, they're not going to say anything to the Russians because, they can't go to Putin and say, please help out the price of oil. But they've got a long history of dealing with the Saudis. What are they going to say to the Saudis? We like low oil prices, or this is bad for the economy?
I think what was very telling was the conversation between Mnuchin and the Russian ambassador in Washington. When Mnuchin spoke with him on Monday, I believe, or Tuesday, and he said energy markets need to stay orderly. I'm finding this very funny, honestly. I'm finding this very funny when the U.S. Treasury Secretary effectively calls for higher oil price.
So the United States, I mean, the key thing is always to remember, the United States has a really big position on both sides of the oil market. It's both the world's biggest consumer, but it's also one of the world's biggest producers.
Right.
As a result, the US tends to favor a sort of moderate oil price. It doesn't want prices to be so high that they hit motorists. It doesn't want prices to be so low that they hit domestic oil producers.
Right.
Back in the sort of the 1985-86 price crisis, the United States actually started putting pressure on OPEC to cut production and raise prices. I mean, there was the point which Dan Yergin mentions in his book, where the Reagan administration sends Vice President Bush to go and tell the Saudis, we need a production cut, we need higher prices. So I think that's always been a feature of American oil policy. It's even more so now, over the last 10 years as U.S. domestic production has grown, that they want a sort of Goldilocks moderate price.
Right.
I think there's also a political dimension to this, which is, in a sense that Donald Trump's road to re-election runs in part through Texas and the other oil-producing states. He needs to keep them on side.
Surely.
They don't have a lot of options.
When was the last time Texas voted for not for a Republican candidate?
But he probably doesn't want the pain in Texas to get too intense.
No.
So my suspicion is that there will be conversations. They will be having conversations with both the Saudis and the Russians to say, let's cut the volume warfare. Let's try to get back to a more orderly oil market. I would guess that they would be quite happy with a price somewhere between $50 and $60 a barrel.
Well, that's interesting because I'm sure
it's a lot higher than we are today.
And it's exactly the Saudis would like 50 to 60. I'm sure they'd be thrilled with that. The Americans would like it. So what about the Russians, Stephen? Why don't they want 50 to 60? Because it supports the shale industry. Is this all about Igor Sechin and his market share?
That's the one bit which we sort of are struggling to answer, because if anything, Saudi going into the pump war makes sense because they have spare capacity and can increase. They can really seriously increase by 2 million barrels per day, probably from stocks. Now they've been producing 9.7. They announced this week they will produce 12.3 million barrels per day. That's a massive increase. They will probably pump from stocks, make their production probably unpredictable. So 12.3 including from stocks in April, then 10.5 in May.
Do you think they'll go for a short, sharp shock and then reassess?
And then bring Russians back to the table?
Yeah. So it'll be real pain in the short term.
Exactly.
If you're going to go all out into a war, there's no point sort of going in with a you've got to go in fully armed, right? Use everything at your disposal. Is that what they're doing?
Yes.
Sorry,
I think anyone can do it in the Saudis.
Yeah.
Yes, exactly.
Well, there's only one.
They can do it. I think the strategy is shock the market for the next few months, and sometime by autumn try to sit down with the Russians and cut another deal. That would be my sort of base case scenario. With Russia, the thing is, Russia, during those meetings, they've been very consistent in telling the Saudis we don't want to cut. And they don't want to cut for one reason. They kept saying that we don't know the impact of the virus. And what we're hearing from sources is that it might have been that the Russian calculations showed that if demand falls by the one unknown is the virus, of course.
Yeah.
And the Russian calculation might have been, well, if demand is going to fall by 5-6 million barrels per day, what's the point of cutting 1.5? What is the point?
Yeah.
And sitting next to China and maybe having already a lot of cases inside Moscow and Russia without really disclosing it at the moment, they probably realize how painful it is called.
So that I think is a good point because between today, what day is it today? Thursday. And Thursday of last week, the world's economic analysis, or what's going to happen macro-wise, has changed completely, right?
Italy's in complete lockdown, 200 people dead every day. So it's just like.
So let's have a look. Let's just move on to that. How bad is it going to be for demand? I mean, no one knows, but what's the best case and worst case scenarios for the impacts on demand? But crucially, given what we know is going to happen to supply, it's going to go up. The supply-demand balance this year. On the world oil market.
So John can go through the main points, but just to give you an extreme scenario, we had an interview with Pierre Anduran. I mean, the very well-known oil hedge guy. We all know he's probably talking his book because he has gone short, but he's saying, I wouldn't rule out demand falling by 10 million barrels per day, which is 10% of global demand. It's a hell of a big figure.
And he's got a hell of a big book, and I'm sure.
He has gone massively short. I agree. I know all the caveats, but that's one extreme example. John, sorry, I've interrupted you.
So as Richard will confirm, I told him I would put together the slides as late as possible. So I put them together yesterday afternoon to try and make sure that they were reasonably fresh, and they're already out of date overnight. Effectively what we've seen, particularly with the introduction of the travel restrictions over the night in the United States, is the oil market and the other financial markets are now pricing for the virtual certainty of a global recession. that this is such a massive hit to so many industries: aviation, travel, tourism, manufacturing, the oil sector itself. You're seeing a massive hit across multiple industries. The markets are pricing for the certainty of a recession in the short term. The key question then becoming whether or not you can provide enough monetary and fiscal stimulus to try and keep that recession relatively short. We've seen the spread, so I gave you a lovely chart showing that the Brent has fallen into contango about $4 a barrel yesterday, which is your slide 15, and we're now already at $6 a barrel. The market is pricing in a huge stock build.
Yeah.
The market's also moved overnight to price in the virtual certainty that the Federal Reserve will bring interest rates very close to zero by the beginning of next month.
Yeah.
So they're currently at 1% to 1.25%. Markets now anticipating that the Fed will cut them close to zero by the end of this month. So we're looking at a global recession scenario. That means a huge hit, as Dima says, in the short term, millions of barrels a day of demand probably likely to disappear. For the year as a whole, most of the three major statistical agencies have all cut their forecasts to either a very small year-on-year growth in oil demand or a small decline. But that was before the latest. So those are already out
the window, right? I mean,
we're effectively looking at the first decline in global oil demand since 2009.
Just a question of how big the decline is.
Just a question of how big the decline is.
Okay, so OPEC spent a lot of time looking at the numbers, saying we need to get OECD forward demand down to X number of days. I can't remember what it was.
Yeah.
And that took them back in 2000. Well, it took them 3 years.
Yes.
And now they're going to wipe that away at the stroke of a.
Currently, the stocks look balanced. 2.9 billion barrels of OECD stocks, 63 days of forward. 63 days of forward cover, fully in line with the 5-year average. No problem on that front. The only small outlier is 18 million barrels of Iranian floating storage sitting somewhere.
Yeah.
But what's going to happen now is that the Saudis selling from stocks. It's this oil is basically moving because they've also discounted it so heavily. It's moving from one stocks in Saudi to US, Japanese, Korean stocks, and elsewhere. And we've already heard, although couldn't really confirm, that the Saudis couldn't even meet the huge demand that they're facing because people are saying, yeah, me too.
So people are stocking up because and traders can make money because of the contango.
It's so cheap. It's so cheap at the moment. $7 billion.
But isn't that ironic? I mean, the demand goes up, but only into stocks, and you don't really count demand until it reaches the end.
And this is, I think, one of the things that is likely to cause some concern for the Saudis, which is that you're effectively giving away heavily discounted oil. You're taking a big financial hit, and you're essentially giving money both to Asian refiners and to the oil traders.
Yeah.
So you're selling under the market. You're moving stock.
So this actually reminds me of the title of this is how is it different this time? This is actually very similar to what cost Zaki Yamani his job.
But the end game is different, Richard.
Well, the end game is different, but sure. But what they did then was they tried to squeeze out everybody by it was called netback. They were pricing they were guaranteeing a refined product margin and selling and prices then collapsed completely.
But it looks like this particular time the Saudis and the Russians are betting on supply peaking sometime next year. Just shale is plateauing, and hence by dropping the price, they're just trying to bring forward that scenario and grab a bigger market share. So when talk resume with Russia and OPEC, say in September or whatever the base case scenario, then the Saudis will say, now we're prepared to cut, but we will be cutting from 12.5, not from 9.7. So their negotiation position and the market share will significantly increase. And what I don't really get about Russia is that Russia can barely raise by 300-400, if only.
No, so that's a good point. I want to ask Ranjith this because I know
Richard,
that
actually, So on the supply side, Sorry, and on the supply side, Saudi is just one part of the whole equation as well, because obviously the volume is immense coming from Saudi, so that is always on top of the headline. But a lot of things that gets left out is also how many of additional barrels the other producers can also bring in, because everyone right now it's in a situation where everyone wants a piece of the cake, so everyone is trying to increase. Like UAE has already announced their aim was to reach about 4 million barrels by the end of 2020. Now they have said they are going to reach 4 million in the next couple of months, and going to be accelerating to the 5 million, which they have planned for 2030. And so which essentially means that 1 million more from UAE. And Iraq obviously means they have a cap in terms of the capacity that they can increase maybe about 200. Mm-hmm.
So I guess the question is here, I mean, everyone's got intentions to raise production. It's an old game. Some of them can squeeze out more, but when the price is falling, the question is, are you prepared to do what the Saudis are doing? And well, the Saudis aren't selling oil at a loss. They produce it really cheaply. However, they've got a budget to service, and that's really what the thing that they need to balance. They are going to be borrowing very heavily. Their budget deficit will be much greater than they were expecting. The question is whether other countries can afford to do that. Not everyone's got the money that the Saudis have got. So what's the realistic sort of guess, because it is a guess at this point, about how much additional oil will come, say by the summer versus where we are, or late spring versus where we are, before this meeting? How much additional oil will there be?
From our side, we expect at least about UAE to increase at least by about 300 to 400,000 immediately, and Iraq maybe about another 100, 150 from their side. Kuwait has another capacity to increase by another 250 to 300 if needed. And of course, Saudi, I'm not entirely sure if they'll be able to reach 12.3 right away, but I'm sure we will definitely see. Sorry? Yeah, these are all
how much additional from the Saudis?
In terms of the additional supply?
From the Saudis.
So the maximum they have produced till date, going back from 2015, is only 11 million barrels per day, and they were at 9.8 last month. So which means we can safely expect them to increase rapidly immediately in April to about 11 million, which in itself is about a good 1.2, 1.3 million increase.
And 11 was from stocks, though. 11 was from stocks. So I think realistically they never produced more than 10.6, 10.7. The rest was they were adding up from stocks. But I agree, maybe a million plus they can add easily.
Okay, so I was quickly doing the arithmetic.
We still have Libya. We still have Libya with another 700,000, which is also locked in due to the internal unrest. So.
Well,
but if you believe the theory that Putin controls Haftar, then another million can be easily added. Because if Putin controls Haftar and their buddies, then you say, well, how about releasing a million barrel of extra?
Well, maybe
and then Libya will take it at any price. Libya will take it at $10 per barrel.
Next time you're in Moscow, maybe you could ask.
I will suggest, yes. I will certainly suggest.
So we're looking at an additional at least 1.5, possibly 2, and if Russia controls Libya, another 3. Well, so in other words, we haven't got a clue how much more, but there will be a lot more oil.
And of course, demand is dropping at the same time. So in many ways, it's the demand drop rather than the extra barrel.
Of course. Well, there could be a gap of 5 million barrels a day?
I think for me, what was interesting was that when the negotiations broke down, the Saudis immediately moved very aggressively to volume warfare. They immediately said that they were going to increase production. Then they said that they were going to start supplying effectively from inventories. They were going to raise supply above their maximum sustained capacity. And then they came out and said that they were going to invest to increase maximum sustained capacity even further from 12 million to 13 million barrels. There was a very aggressive response. They didn't have to do that. They could just have said, we're going to leave output unchanged, we're going to increase a little bit. So it was a deliberately very, very aggressive strategy. It was a sort of shock and awe tactics. And I think it was designed to force, either to force the Russians back to the negotiating table very quickly, or to force the White House to intervene and lean on the Russians. It was designed, I think, to create a sense of crisis get everybody back around the table as quickly as possible, and ensure that any price crash, any volume war was short and sharp, rather than the very long, drawn-out conflict that you had in between 2014 and 2016. So it was shock and awe tactics. The risk, I think, now is that this is all coming down to the calculations of basically three men. MBS in Saudi Arabia, President Putin in Russia, and Donald Trump, all of whom are very attentive to their image, none of whom wants to appear weak, and none of whom wants to appear to be caving into pressure quickly. So we have moved into this realm of where, it becomes all about the strategic calculations of a very small group of people, and ultimately three guys, all of whom want to protect their tough guy image. So my biggest fear is that although I think the Saudi strategy has been shock and awe for a short, sharp conflict, a sort of 7-day oil war, and then we all get back around the table and we agree to the cuts that Saudi Arabia originally wanted, there is a possibility that this is a miscalculation and that the 7-day war turns into a 7-month or even 2-year conflict.
Well, the things that are outside the Saudis' control are, well, first the US response, which, we were hugely surprised by last night with a ban on European flights into the US. And then, coronavirus and the impact on the economy. That is a snowball effect, which is already out of control, let alone under Saudi control. We have no idea how bad this is going to be for the economy. So they could say, okay, we're going to cut production, but as you said earlier, Dima, it may make no difference because demand is simply disappearing.
I don't know what's going on there. Well, we're trying to understand what's going on there politically, the 5-dimension game. But the one thing that Russians said openly is kind of makes sense. We don't know what's going to happen to demand.
No.
We just don't know. Yeah.
And that, I guess, is sort of makes this crisis similar to 2008 because, let's face it, demand fell off a cliff. And I don't know whether you remember, but the equities market dropped in 2008 and oil kept on going up because China was buying. China was in a huge expansionary phase, and that certainly isn't the case anymore. China was growing by something like 10%, and oil kept on going. It went to its records, even while equities decided that the party was over. Let's just get on to the people who are making hay while this storm is brewing. The contango in the markets, whereby prices are much lower. Which way around is it? Contango and backwardation? I've forgotten. Forward prices are now. I wanted the expert to tell me. I haven't forgotten.
When you were my editor, you were beating me on the head for not knowing this.
So what does this mean for people who are storing oil? We've already talked. Ranjith, do you want to give us an idea of what you think this means for the amount that's going to get stored, at the demand centers as opposed to in the production centers? Any idea?
So that's exactly what we are seeing in terms of the tanker demand right now, because it's been on a frenzy for the last 2 to 3 days, especially. And the Saudis, one of the strategy was shock and awe, but then they are not just stopping with just announcing about it. They are actually implementing most of their announcements that they have gone ahead. And the biggest shock to the tanker market was their shipping arm, Bahri, which took in almost 14 VLCCs in just a matter of 1 or 2 days. So that what it has done is it has created.
So, look, I think what's interesting about this is that there isn't as much demand. We know that, but there is at the moment massive demand to move stocks from one place to the other. So the question for the tanker industry, which is always, it seems to me, has been an industry in some form of crisis one way or another, is that all of a sudden they've got, everyone wants their ships. But surely they're not foolish enough to go and build a whole new set of the things because, once that stock has been filled, then, there'll be nowhere to put it. I guess other than in floating storage, And
that's why I think you're seeing, the contango has blown out to $6 overnight, which is that effectively the market is saying we're going to fill global storage to the limit. And that we're actually going to get into a situation where anybody, we will have distressed storage that effectively, if you have excess barrels, you will be searching around for anywhere to stick them, including the local neighborhood swimming pool. So that effectively the $6 contango is, we're back to the world of the super contango, storage totally full.
And Dimitry, this is probably your area. Who are the companies who are best positioned on the trading side to take advantage of these people who can take a big, who've got deep pockets to get oil from one place to another, who know how to trade the contango and have got storage as well?
So these are the usual suspects. This is Vitol, Glencore, Trafigura, Mercuria, Gunvor, Litasco. These guys have been doing this very well. So my small concern is all these guys had a phenomenal year in 2019. Mm-hmm. Phenomenal. They made a killing on oil, on products.
They did well.
They did very well.
Yeah.
And I have never seen the trading houses repeating one record year after another, even though it looks very, very good for them at the moment.
It's on storage, but if they were long going into
the market, but yes, if they were long crude oil products in the current environment, plus they've since the last crisis they've increased the ownership of assets. Those are not doing great at the moment. I mean, some of the American terminals or refineries in Europe, I mean, I still have question marks how well those will be doing. So the contango market will certainly help them big time, but of course a lot will depend how they were positioned ahead of the price crash.
Yeah. So I guess that's a story that you're going to be producing for all our lovely clients on the line. Yeah. No, I think it's an interesting one. Always interesting is, because no one predicts this sort of thing, but some people get ahead of it. Pierre Onderon has raised the flag and said he's done well, and he will have done because
Pierre is doing only paper. Yeah, I mean he has never done physics.
No. So, he got the right side of it. He's been long for a long time. He actually lost quite a lot of money when he was long at one point.
Indeed.
Yeah. Yes. So, are you hearing anyone else who was overly long, or is that not something you want to discuss on an open line?
There's so much hearsay in the market.
Yeah.
You've got to be careful. People like saying that their competitors have lost billions of dollars on the wrong trade. I mean, the honest truth is it probably, in my experience, it never really materializes when the year end comes and people show their results.
Yeah.
It never really
so when it comes to results, the companies that do have the test are the those listed. I remember about a year ago there was a big discussion around whether the majors should be spending more, because some investors were saying, $75 a barrel, why are you spending more? And the clever ones were saying, well, because, we're not sure where this is going. Now, so who are the majors who are best positioned to weather this? It's not long since they've been through this in 2014, 15. And who are those that who may not be as well positioned? Do you have a feel for that yet, or is it too early to?
It's too early, but the feel is, if we simplify things and look at the main sort of points where they could feel maximum pain, people who have gone very aggressive and bought acreage in the United States, that is Chevron, Exxon, that is BP with its latest BHP acquisition. People who are better positioned are those who have never gone and produced in the States, Total and Eni. They said, we're not going into this. Balance sheets are, Shell has Shell and Total are perceived to have the strongest balance sheet. At the moment, BP has done fairly well. The honest truth is that debt is rising heavily, has been already rising quite heavily. The borrowing costs are on the rise because of the green pressure. More and more banks are simply unwilling to lend money to oil majors due to their ESG policies. And they already had to borrow heavily to maintain their capex and dividend, and also they need to invest in renewables because this is what investors want. And even though renewables are not making as much money for them as the core oil business, they've been forced to invest more and more and more into renewables and green energy. So the picture looks bleak. We will see a lot of, if that oil route extends for more than just a few months, which is the base case scenario, as John said, and I would think it may last longer than just a few months. Then we will see again, as in 2014, people going on a capex diet, people really cutting costs and investments, and we will see layoffs. We will see asset sales. It's going to be tough.
Yeah. Okay. So you mentioned ESG and there's been obviously a big shift going on to renewables. John, what's your assessment of whether there will be an impact on the renewables business and on the acceleration of energy efficiency in the transport sector in particular, which is where most fossil fuel is used, oil I should say, rather than coal. Does this slow that? Because at low prices, obviously, oil is competing much more than it might have been. Or what's your assessment? Does the renewables industry suffer as well?
I think historically, oil price crashes have always helped the oil industry buy back demand and help sort of protect its market share, and have been damaging to competing energy sources. And you would expect something very similar to happen this time around. What I think is different, however, is that I think both China and the European Union have strategic reasons for wanting to move away from dependence on oil. The Chinese have a long-term strategic interest in reducing their dependence on imported oil. They feel that this is a key source of economic vulnerability to them. They also feel that it's a key source of strategic vulnerability, given that the US Navy could disrupt their supply line.
Yeah.
So I think the Chinese state has a strong interest in reducing oil dependency and shifting towards electric vehicles, and I don't think that will change. If anything, I think given the acrimonious relationship between the United States and China, I think that the incentive to shift away from oil is intensifying. In the case of the EU, it is less worry about dependence on oil imports, and it's more concern about climate change and CO2 emissions.
Yeah.
So I think both China and the European Union are looking at a long-term strategic shift away from oil as a transport fuel, and I think that is largely invariant to the price. So I don't think the drop in prices will slow that down very much. One thing that probably does slow it down a little bit in the short term is if you get an overall global recession, it puts most companies into survival mode.
Yeah,
makes them a little bit less willing to invest in sort of breakthrough technologies or those kind of sort of radical innovation.
Yeah.
So I think it probably slows that innovation down for a year or two.
Okay, thanks for that. We've got a question in which I think is a good question. We have covered it, but I'm going to put you all on the spot. Can you clarify current expectations on the demand drop in million barrels a day, and for how long? Well, let's just say this is March 2021. What was 2020 demand, global demand, compared to 2019 in the end? You have to guess.
March 2021.
We're in March 2021, and we're saying, well, that was 2020. Demand went up, down, sideways by, and supply went up, down, sideways by. What would you guess at this point? And then I will buy you all a donut if you don't mind.
The loss. Let's make it April. So because we're halfway through March, the loss of demand in April could be very, very large. China's demand is probably still down from where it was because the economy is still recovering. The travel ban into the United States is going to have an enormous impact.
Yeah.
I mean, not just the direct impact on jet fuel, but also I think it's effectively, the US economy is going to enter recession. So you're probably looking at a demand loss in April of several million barrels a day globally.
So on average for 2020, or come up with a range.
I would guess on average, we're now looking for the year as a whole. I would guess on average we're looking at a demand loss of several 100,000, maybe even 500,000 or more barrels a day.
Ranjith, what do you think? John's going for 500,000.
Yep.
Plus.
Yeah, my guess would be maybe slightly on the lower side. That's mainly because, like I said, how long this impact of the virus is going to play a huge factor in terms of how much
I agree.
Demand to go. Yeah. Exactly. Yeah. So considering or assuming things would maybe not resume back to normal completely, but even to where it was start of February or mid of Feb, I would expect the demand for next year to have dropped by maybe around 250,000, maybe not 500,000. But again, at this point, we are just taking a guess at this point without having a clear indication of how it's going to shape up in the remaining 9 months.
Okay, Dima?
Yeah. Well, I'm not a doctor, Richard. I have no clue. I mean, if things continue as they continue now, 10 million, like Anduran says, 10 million barrels.
Yes, 10 million.
I mean, honestly, you look at the panic.
What is global demand now?
100 million.
We're up to 100.
Yes.
So we're in. You're talking 10%.
10%, easy.
I would go for something like 1.5. Okay, so we got a bit of a.
Okay. So between 5 and 10.
So one of the key questions is the sustainability question. So China demonstrated back in January and February that you could try to bring the virus under control by basically shutting your entire economy down.
Yeah.
For 3 weeks, 3-4 weeks. I mean, in the end, they may or may not have contained the virus outbreak, but the economic costs became unbearable.
Yeah.
And the Chinese government has now very much shifted towards we must get back to normality as quickly as possible. I think we're going to see something very similar in the OECD countries. I mean, Italy has basically locked the entire country down. It may help break the virus transmission in the short term. It's clearly not sustainable in the long term. The same question applies to the US. I mean, the 30-day travel ban and the associated impact is not you can't sustain this for months at a time. You can perhaps sustain it for a few weeks. You can't sustain it for months at a time. I think there will have to be. I think at some point over the next few weeks there will have to be a shift towards we need to get back towards business as normal as a normalization of business activity.
Okay, so the risk then will be, basically to say, okay, people are going to contract this, some people will get very ill, and some people, for some people it will be, terminal. So you think that that politicians will say the risk of that is less than the risk of the economy going
that is the awful that is
terrible trade-off. But that's what Trump switched from one side to the other, right?
Yeah.
A week ago he was saying, this is flu, there's nothing to worry about.
Yes.
Last night he says no one's arriving in the US.
And that's what that is the awful trade-off that all policymakers have faced. And as we've seen, they can shift from one decision to the other quite quickly. I mean, China went through exactly the same thing, which was at one stage it was all locked down the country to stop virus transmission. But by sort of early February, middle of February, it was all, this is causing the economy to collapse. We need to get people back to work as quickly as we possibly can.
Yeah.
I have a sneaky suspicion that we will follow the same trajectory, which is that within a few weeks, the focus will be on, look, these lockdowns are unsustainable.
Yeah.
The economic damage is huge. It's very difficult to keep the country going. If your supply chain starts to empty out, your shops start to become empty of stock. it just isn't sustainable other than for a very short period of time.
Yeah. Well, okay. Well, look, time is up, I'm afraid. Fantastic discussion. Thanks everybody for your questions and for listening in to this Refinitiv webinar.